Welcome to the Deep Dive. Today, we're strapping in and going deep into the state of cloud identity and security.
We are. We've got the latest earnings presentation and the 10Q filing from Okta Inc. right here.
And this covers their third quarter for fiscal year 2026, which just ended on October 31st, 2025.
So very fresh data.
Exactly. And our mission today is really to cut through the corporate speak and get right to the core. We want to figure out what's actually driving their revenue.
And are these efficiency gains they keep talking about real?
Right. And maybe most importantly, what are the big risk factors? I'm talking about cybersecurity, competition, things that are really going to shape their future.
Well, it's a critical time to look at them. You have to remember Okta's position. They really are the leading independent identity partner.
And that's a key word, independent.
It is. They're sort of the engine behind this huge industry shift to what we call zero trust security. Identity isn't just some IT thing anymore. It's the main security perimeter for basically every company out there.
Especially now with so much hybrid and remote work.
Absolutely. So they're sitting on a market that's not just big, it's mandatory.
Okay, so let's unpack this, starting with the foundational numbers, the big picture.
So for the full fiscal year 2026, the total revenue projection is landing at around $2.6 billion.
And that $2.6 billion, that's our baseline.
It is, because what it shows is a compound annual growth rate, a CAGR, of 16% from fiscal 23 through 26.
So even as a mature company, they're still pulling in solid double-digit growth.
They are. The top line is still expanding.
Let's translate that growth into customers. I mean, how wide is the net they've cast?
It's a very wide net. They're boasting over 20,000 total customers globally.
But the real story is in the high-value ones, right?
Exactly. The real indicator is the enterprise segment. We're talking about customers spending over $100,000 in annual contract value, or ACV.
And that number is now, what?
It just crossed the 5,000 mark. It's at 5,030. And what's really encouraging is that this top tier is still growing at about 7% year over year. So they are still landing those big, important accounts.
And nearly all of that, something like 98% of the revenue, is locked in through subscriptions. In Q3, subscription revenue was $724 million. That's out of a total quarterly revenue of $742 million.
Which is a really robust 12% increase year over year.
But I want to pause on something here. Professional services revenue. It jumped to $18 million.
Yeah, that's a 31% jump year over year. That's a big percentage.
Yes, and that kind of growth in, implementation and integration support. It suggests customers aren't just renewing, they're doing complex, large-scale deployments that need a lot of support.
Which is a great sign. It signals that future subscription revenue is going to be very sticky.
So it's a leading indicator.
You're absolutely right. And if you want even harder evidence of future revenue, you look at their remaining performance obligations, the RPO.
Their backlog, basically.
Essentially, yeah. It's contracted, but not yet earned. And as of October 31st, that RPO stood at $4.292 billion.
That is a huge commitment from their customer base.
It is. And the most valuable number in there is the current RPO. That's $2.328 billion.
Okay, and current means what?
It's the revenue they expect to actually recognize in the next 12 months. So it makes up 54% of that total backlog. It gives you huge visibility into their growth.
And to put that in perspective, the total market is massive.
Oh, yeah. They estimate the total addressable market for just workforce identity and governance is $21 billion, and that's just domestically.
So you can basically double that for the international opportunity.
Conservatively, yes. So they have a massive runway ahead, assuming, they can actually capture it.
And here's where it gets really interesting. We go from how many customers they have to how much their existing customers are spending.
Right. The expansion.
And that spending behavior, it tells kind of a mixed story. It seems very influenced by the macro environment.
It is.
Their dollar-based net retention rate for the last 12 months is 106%.
Which, on the surface, sounds pretty good. Existing customers, after you factor in anyone who left, still grew their spending by 6%.
But you have to compare it to last year.
And that's the catch. Last year, that rate was 108%.
That dropped from 108 to 106. I mean, it might be the most telling data point in the whole report about what the market is feeling right now.
I agree. It explicitly links that slower expansion to budget constraints.
And so companies aren't dropping identity security.
No. It's way too critical for that. What it means is they're prioritizing their core renewals. They're keeping the lights on.
But they're pausing the big expansion projects.
Exactly. They're saying, we'll hold off on that big, shiny identity governance upgrade until next year's budget. And that forces Okta to work a lot harder to get those upsells.
Okay, so when expansion slows, you focus on product depth, which brings us to their recent acquisition.
Axiom Security Ltd. They bought them on September 4th for $54 million in cash.
And the purpose was very clear. Broaden their privileged access management, or PAM, capabilities.
This is a classic buy versus build move. PAM is a high-stakes area, and this deepens their offering.
And looking at the accounting, they recorded $16 million in developed technology.
Right, intangible assets. They expect to use that over the next 3 years. But the bigger number was the goodwill.
$40 million in goodwill. For anyone listening who isn't deep in financial filings, that can sound strange.
It can. But essentially, Okta paid a $40 million premium that isn't tied to, physical assets or even just the code itself.
So what's it for?
It's attributed mainly to the assembled workforce. They paid a premium for the talent, for the team that was already there, and for the speed of getting that team and their tech integrated.
They were buying expertise.
And the ability to execute quickly on a strategic gap they had.
All right, let's shift gears to maybe the most dramatic part in this whole story. Operational efficiency.
That's a huge shift.
Because if that external revenue growth is getting harder, they have to deliver value through internal cost control.
They have to expand margins.
And I have to say the improvement here is just staggering.
Yeah.
Looking at the non-GAAP operating margin, they went from negative 0.5% in fiscal 23.
Meaning they were losing money on operations.
All the way up to a Q3 performance of 24.0% positive. I mean, that is a complete overhaul in a very short time.
Yeah.
How did they do that?
Well, that kind of swing from negative to a projected 26% for the full year, that's not just about, layoffs. It speaks to a deep efficiency in how they delivered their service.
Okay.
And the proof is in their subscription gross margin. It hit a remarkable 83.6% non-GAAP in Q3.
That's incredibly high.
It is. And in a cloud business, high gross margins like that often come from being more efficient with your infrastructure, getting a lower relative cost for the revenue you bring in.
So they've optimized their cloud and support systems.
Exactly, making every dollar of revenue vastly more profitable.
And that discipline shows up directly in cash flow, the non-GAAP free cash flow margin.
Uh-huh.
It tells a very similar story.
It does. It rose from just 3.5% in FY23 to 28.3% in this quarter.
With projections aiming for almost 29% for the full year, this company has figured out how to generate a lot of predictable cash.
Yes, and the market absolutely loves to see that. And, this whole efficiency story is actually getting an unexpected boost from Washington.
Right. I wanted to bring this up. The impact of the One Big Beautiful Bill Act, which was enacted this past July 4th.
It sounds like a made-up name, but the financial side is very, very real.
Especially for innovation-heavy companies.
This is where politics meets corporate finance, and it's fascinating. Before this, companies had to amortize or spread out their R&D expenses over several years for tax purposes.
And the new bill changes that.
It does. The core provision is permanent. Immediate expensing of domestic R&D costs, plus 100% bonus depreciation for certain assets.
So in simple terms, what does that mean for Okta's cash flow?
It's like a massive shot in the arm for their innovation budget. Instead of waiting 5 years to get the full tax deduction for their R&D, they now get to deduct 100% of those domestic costs immediately.
Wow.
It drastically reduces their current taxable income, which means they'll pay a lot less in federal and state cash taxes. It's effectively subsidizing their R&D.
So it lowers the cost of innovation.
Dramatically.
But despite all this incredible financial efficiency, we can't ignore the elephant in the room.
The cybersecurity incidents and their core mission of security.
The source material is very direct about it. It says past incidents harmed their reputation and hurt financial results.
And that they expect those effects to continue.
We're talking about two big events, right? January 2022 with the third-party provider.
And then October 2023 with the unauthorized access to their own customer support system. For a company whose entire value proposition is trust, this is the ultimate friction point.
So here's the question. Can a company whose reputation is built on being the gatekeeper ever truly recover from repeated, high-profile security incidents, even if third parties were involved?
That is the critical question, isn't it? Financial performance can bounce back fast, and these margins prove that, but reputational damage is stickier. It just is.
Every sales pitch has to overcome that history.
Exactly. The best they can do now is just demonstrate they're investing heavily in resilience, which brings us back to how they're spending their money.
Before we get to future spending, let's note that they've managed to put some big legal headaches behind them.
That's true. The securities class action lawsuit, which was all about their cybersecurity controls, that was settled back in May 2024.
For a total of $60 million. And what's interesting is that most of that was covered by D&O insurance.
Right, but the company itself still had to pay a $10 million retention.
And with their huge cash reserve, is that $10 million a big financial hit? Or is it more of a reputational cost to just close the chapter?
I think it's more symbolic. $10 million is completely manageable for them. The real significance is that they just got final court approval for that settlement in November, and they wrapped up the related derivative actions this fall.
So they've spent the money to legally close the book on the past.
Yes, so management can now focus entirely on the future.
But the future is competitive, especially with giants.
Yeah, the 10Q filing points this out very clearly. Intense competition, particularly from Microsoft. I think of it like this. Okta is a highly specialized, best-in-class Formula One racing team,
Okay.
and they're trying to compete with the full manufacturing power of a giant like Mercedes-Benz.
That's a great analogy. Microsoft doesn't even have to win on price. They can just bundle identity access for free into their huge enterprise agreements.
And force customers to question the cost of a dedicated, independent solution.
Exactly.
And that's on top of their own internal tech risks.
Right. They rely heavily on third-party data centers like AWS. Any interruption there is immediately an Okta problem. And now they're citing the emerging risk of AI integration.
I saw that.
Deploying AI brings potential regulatory scrutiny, liability. The tech is just so complex and it's evolving so fast, it's a whole new category of risk.
Okay, let's quickly touch on their capital structure. They handled their debt maturity pretty decisively this quarter.
They did. They settled the full $510 million of their 2025 convertible senior notes in cash on September 1st. That cleans things up a lot. But now the attention shifts to the remaining debt, the 2026 notes.
Right. The $350 million principal outstanding on those is now classified as a current liability.
So, for the average listener, why does that accounting distinction actually matter?
Well, it's important to know it's an accounting change, not some sudden crisis. Because those notes mature on June 15, 2026, which is less than a year away, the rules say you have to move it from long-term debt to a current liability.
It just means the bill's coming due soon.
Exactly. But if you look at their liquidity, that classification it's almost meaningless. Their total liquidity cash investments was a staggering $2.463 billion as of October 31st.
They could pay that off several times over.
Without even blinking. And that cash is there for working capital, general corporate purposes, and crucially for potential future acquisitions.
And just to put that cash pile into context, their operations generated $626 million in cash over the last 9 months alone.
The machine is just generating cash faster than they can spend it.
So if we boil this whole report down, what's the core message?
I think the core message is one of successful operational leverage. Management has pivoted this company to strong non-GAAP profitability and really robust free cash flow.
The margins are increasing substantially.
And that pivot was absolutely essential because it had to compensate for those macroeconomic pressures we saw in the slight but significant drop in the customer retention rates.
So the final takeaway for you, the listener, is that this shift to efficiency, it's not just a projection, it's a verifiable fact from these results. However, despite cleaning up the financials, the business is still tethered to that ultimate security risk. Their brand is just highly susceptible to financial and reputational hits from cyber events, even ones involving third parties.
That external risk is the primary shadow hanging over an otherwise stellar financial turnaround.
And that raises a really important final question.
It does. When you consider that they have to fight off competitors like Microsoft, and they have this new tax law basically giving them a subsidy for R&D, how are they going to strategically deploy that $2.463 billion in cash?
Right. Do they go on a buying spree?
Do they focus on acquisitions to fill product gaps like they did with PAM? Or do they use that cash to overinvest in the resilience of their own third-party infrastructure to try and mitigate the security risks that keep challenging their reputation?
That's the strategic choice that's going to define their next few years.
It is a fascinating tension between offense and defense.
A truly fascinating tension. We encourage you to keep researching and connecting those dots. Thanks for joining us on the Deep Dive.